Now, here's your Care for My Wealth guy, Chris Klein.
Hello and welcome to the Care for My Wealth show, abbreviated, so let's try and make it quick. Most of you, if you've been listening to me for some time, know that I send an email to clients every single day that U.S. markets are open, just in an attempt to try and help make sense of what may be senseless or what might look senseless in terms of markets and market activity. And so the last couple days, we've had some catalysts, if you will, for data that has come out. PPI came out yesterday on Monday. CPI came out today. And the release of those kinds of data sets always presents a macro risk event. And that can, in today's, well, I guess for lack of a better word, appearance of manipulated government data. But, I guess I digress if I go down that road too far. These macro events, they present some real volatility risk to markets. And so one of the things that I said in my morning email was that when the CPI data had come out, it was 0.1% below expectations. It came out 2.9% year over year. Expectations were at 3% for that data set. And my comment is what's likely to happen, and emphasis on likely here, just simply because there's a lot of options activity that is controlling the movement of markets these days, and we've got options expiration, and it's a big one towards the end of this month. But the likely action, I commented, would be that the puts that were bought, the protection, if you will, are going to become worthless and useless in whatever protection they were looking for, and that it would cause people to chase markets to the upside. And with that, the entire volatility curve, the VIX curve, probably comes down towards 15 over the next couple of weeks. I don't know that it goes a whole lot lower than that. It could, just simply because we've got NVIDIA earnings on August the 28th, which of course could be a very large catalyst for the market in either direction. But the low end of the calculus of the rate of change of price, volume, and volatility of volatility itself is sitting at 12.85. VIX was down 1.91 points today. And, and look, you want to look at VIX in terms of points, not necessarily percentage, okay? And so what did we have? Well, we had this massive spike of volatility that took place back on August the 5th. And, oftentimes when you get a spike like that, with it closing near the lower end of its daily spike, you tend to see volatility just leak out, and that's continued to be the case. That's been what's happening here most recently. VIX has converted itself into a bearish trend with what I would call a resistance level now at 2660. So what does it mean? It just simply means that if volatility comes down towards 13, it wouldn't surprise me one bit if it re-spiked towards 26, freaked out the entire world. The end is here. It's coming. That whole thing, and and then fades away again. Now we'll see. Now my expectation is that it would likely fade away again fairly quickly, simply due to gamma and flows. And so one of the other comments that I made was that before this morning or before today's trading started, we were still in what was called a negative gamma setup. And again, negative gamma just simply means in the options world that when that's present, it creates an environment where dealers sell into a dip versus buy it. It's kind of the best way to look at it. So they chase the sell versus buy the sell. And the bottom line is that environment creates conditions where you can get a chase, but you can get a chase in both directions. Increased volatility is another way to look at negative gamma, right? But the key is that we were not in a deep negative gamma cycle anymore. So every single day there's a reset, if you will, of how gamma is structured in the options market. And there's always this level that it could flip at. Well, the flip level for today, Tuesday, August the 14th, Wednesday, August the 14th. Man, time goes by too fast for me. The flip level for that was at 54.79. Well, we didn't hit that. We hit that on futures, but we didn't hit that on the S&P 500 itself. We got close, 54.55. So what's interesting about that level, 54.79, 79 on the S&P 500 is that happens to coincide exactly with trade resistance. Now remember, trade resistance is kind of the machine level when it comes to how things can get chased in either direction. And so what do I mean by that? Well, if you calculate the rate of change of price, volume, and volatility, you come up with a level. And then that level needs to be compared to a time series. And the time series that are most valuable are less than a month and then greater than 3 months. Less than a month is that trade level that I talked about. That's kind of how the machine functions. And then more than 3 months is the trend level. Trend levels become very, very valuable because that's where trend following systems will kick in gear and start to buy things or sell things, depending upon what's happening in the market cycle at that time. So we're not in this deep, deep level of gamma like we had been when markets sold off last week. And that flip level of 54.79 is close, but we're not there yet. But it also coincides with a strong level of resistance for the S&P 500, right? If in the event we get above that, gamma flips positive and volatility just becomes a little bit more mundane, right? So we need to keep that level in mind. Keep 54.79 in mind for the S&P 500. It would be the area where we would flip ourselves back above that trade cycle, and now trade becomes support that every time it gets near that, you'll find the trend following systems buying it, right? And then that, of course, would help support an increasing value of the S&P 500 over the near term. And do I expect that? Kinda. And the reason I kind of expect that is because, at least on our systems right now, the S&P 500 has flipped back into a bullish trend. Now, it's not by much. It's by the hair of its chinny chin chin. But it has, in fact, flipped into a bullish trend. And so that's something that we want to watch for, as that literally has just happened. And oftentimes, when you get a flip back into a bullish trend, it can start a decent move from there. Now, the macro backdrop is a little bit different than what it's been the last time, last April, for example, that we got into an environment where it broke through that trend level, started to act very bearish, market had a correction, and then it moved back up above it again, and everything just started to move higher right into the middle of July. The macro backdrop is different, right? And the macro backdrop right now is simply looking at growth slowing, along with, at the same time, this disinflationary, potentially deflationary cycle starting to kick in gear. Now, it's going to wobble a little bit, right? When you look at base effects and you look at how CPI is calculated, there's a very real possibility that we see a reacceleration of inflation as we head towards the end of the year, which could blow up how the Federal Reserve decides to change their interest rate cycle and what they intend to do with interest rate cuts that everybody in Wall Street seems to want so badly. And, so we kind of got to see how that works. 1 month realized volatility is still above 3 month realized volatility. So that just simply means that volatility control funds are usually, in that condition, net sellers. And so what can happen in a macro environment like this is that where we see disinflation to deflation, plus all the above that I just talked about, is that things can go either way, and they can do it kind of fast. A breakout above that trade and trend level that I talked about, or a failure below that trade and trend level. Of course, one is bullish and one is bearish. Either of those can be on the table until it's broken, right? So what do I want? What do I want? What do I want for Christmas? Yeah, okay. I'm not going to sing on this podcast ever. The S&P 500 that you need to pay attention to is that 74.79 level. That's the level that if we break up above it, chances are really good that it will, in fact, have changed its condition and markets probably start to move themselves higher. Now, that's conditional. That happening doesn't mean that it's going to go straight up. That happening means that the condition structure has likely changed a little bit. But we've got some things that are against it that we have to pay attention to. The low end of the long-term range, again, the calculus, the rate of change of price, volume, and volatility when looked at a much longer-term cycle, like 3 years, that number is all the way down at 5,100 for the S&P 500. The range of this thing has widened out a little bit simply because of the recent volatility that we had. And that's normal. You get a lot of volatility, the price volume volatility range widens out. And so now the low end of the range of the daily cycle of the S&P 500 is all the way down to like 5,200. If that happened, well, then the bullish condition, the bullish trend would have been broken again. And so this is what happens in this macro backdrop while we still happen to be in negative gamma. You get a lot of up and down, a lot of flipping and flopping that we got to really, really be careful with. So I've got to be cautious about how this whole thing is set up right now. And I hate to use the word warn. That's probably too strong of a word, because if I look at this out on a weekly basis, and this is probably a little bit more valuable for you longer-term investors. On August the 5th, when markets sold off, everybody freaked out. VIX went to 65. The S&P 500 tapped its long-range trend level of 52.18. And at that time, we also have a volatility metric that rolled over. And usually when that happens, it pushes prices higher. So we are in kind of the middle of a long-term range. We're near the top end of this intermediate to shorter term range. And so what does all that mean? It just means that we've, while under 54.79, probably going to get some volatility both up and down. And then if the market does in fact go through a sell-off again, it could take us all the way to 5,200. But if 5,200 hits, it's likely an extremely good place to buy. Now, we could just as easily from here, this is going to sound crazy, we could just as easily from here go to 5,700. So the macro backdrop has a lot of importance behind how this works. Now, the flows of the system, the machine, how money was flowing, suggests that for the very least, tomorrow into Friday, we could have some very bullish conditions. We could have some very bullish environments for this market. And so I'm not taking away the possibility that we could see a pretty good bump going into the weekend. And we just have to see how the markets close, because flows will control that stuff. I talked a little bit earlier about growth and how it's slowing. The macro backdrop is characterized by a growth slowing component. And right now, if you look at forward earnings per share estimates for the NASDAQ 100, they're rolling over. Given that most of these companies are growth companies, a lack of growth in their earnings, well, it seems a little ominous, wouldn't you say? Some rollovers are much worse than others. We just have to consider what kinds of rollovers have happened in earnings per share numbers in the past, and how they have been affected by markets or vice versa. That said, I wouldn't be surprised if the bulk of this decline is coming by the Magnificent Seven, right? Apple, Amazon, Microsoft, Tesla, NVIDIA, Google, Netflix, right? Meta, right on down. It just wouldn't surprise me that they're the ones that are actually leading the decline in the rollover earnings per share, since they're the ones that were propping up the earnings per share readings over the last, 2 years. So we might be seeing the start of this earnings rotation and consequently some normalization in the NASDAQ index. The NASDAQ index presents much, much more downside risk than what the S&P 500 does. And that's an important condition for you to recognize. If in the event you are an investor, the S&P 500 in this market backdrop is a much safer choice, a much better choice, in my opinion, based on not just the macro backdrop, but based on the technicals of the whole thing, based on the math of the whole thing. It would be a safer play, if you will. And so we'll have to see how this plays out, but those are some conditions that we want to pay attention to. Let's first look at the S&P 500. If it busts above 54.79, the gamma profile changes, and we likely continue to see volatility get squeezed. But for right now, there's not much more downside squeeze in volatility that I would really expect. As I said, the low end of the rate of change of price, volume, and volatility of volatility itself, the VIX, is at about 13, closed at 1620 today. You can see there's not as much downside as when it was at 65, right? So we have to watch that, right? And what I would expect to happen is that we see markets either break above that 54.79 in the S&P 500 and then kind of roll sideways, digest some of the gains, all that good stuff, or it fails there. If it fails there, it'll coincide with a pop in volatility off that 13-14 level. And if it pops off that 13-14 level for volatility, it's going to run to about 26. If it runs to 26, I think it probably fails. That probably coincides with a low in the S&P 500 near that weekly longer-term level of roughly that 5,200 that I talked about. That would then more likely than not provide a pretty good buying opportunity. But between now and then, you're going to have a lot of daily fits and starts. You're going to have these volatility kinds of setups that create some pops and drops. You just have to deal with some of that emotion that goes with it. Our machine structuring right now is suggesting that the flows of the market were very positive going into today, Wednesday, August the 14th close. And so therefore, it would not surprise us that tomorrow is a bullish day, as long as we continue to keep S&P futures above 54.71. So remember those numbers, write them down, think about them, use them however you want to use them. If you'd like to get in touch with me, you can do that via email, info@careformywealth.com. That's info@careformywealth.com. You can check us out online, careformywealth.com. Or if you'd like to have a good old-fashioned chat, I would encourage that. 866-596-9886, 866-596-9886. Conditions are good for a number of things in markets, but we've got a lot of catalysts that are happening yet this month. NVIDIA earnings, Jackson Hole, options expiration. We're not that far away from an election. You've got the crazies over across the pond talking about monkeypox or some stupid thing, right? Yeah, I have a problem with that. I don't believe those people. I don't believe them as far as I can throw them. But it does affect people's perception coming out of what occurred back in the COVID days. So how will that affect markets? I have no idea. But right now, it's not affecting them at all. Futures continue to trade above that 54.71 level. And until that breaks, until we lose that, well, then we likely have some bullish conditions to work through here. So that's that. If you want to chat, I'd love to hear from you. Again, info@careformywealth.com or 866-596-9886. God bless you. Have an amazing day, an amazing week, and we'll see you next time.